Let's start with a simple example. Say you're 52 years old. You've done really well financially, you've accumulated about $2 million in investments, and you're thinking you'd like to retire around 58. And then the market drops 30%. Now, your $2 million portfolio is only worth about $1.4 million. Obviously, losing $600,000 on paper doesn't feel very good. But at this point in your life, I don't think the $600,000 is the biggest problem. The bigger problem is your time. Because maybe the market recovers. Historically, markets usually have. But how long does that recovery really take? And more importantly, what does that do to your plan to retire at 58? Does 58 become 60, 63? It's hard to say. And that's why I say that you can recover money, but you can't recover time. And as you get closer to retirement, that changes the way that I think you should look at investment risk. For most of your career, your investment strategy probably didn't need to be terribly complicated. You save money, you invest it, you keep buying when the market drops, and you ride out the volatility. And you let time do most of the heavy lifting. And frankly, that strategy probably helped you build a lot of the wealth that you have today. And I'm not saying that that was wrong. The problem is that your situation has changed. When you're 30 or 35, your primary goal is accumulation. How much you save is more important than what your investments do. You need growth, and you have a lot of time to recover from mistakes. But when you're 50 or 55, you still need that growth. And in fact, you need your money to continue to grow for another 30 to 40 years, especially depending on your retirement timeline. But now there's a lot less room for a major mistake. Withdrawals are getting closer, retirement's getting closer, and time matters a lot more. So the goal changes from simply grow the money to grow the money and protect the timeline. That's a very different investment problem. So this creates what I call the retirement investing dilemma. On one side, you can stay aggressive. You can maintain a large allocation to stocks and other growth assets. You have more upside potential, but you also have the potential for much larger drawdowns. And now those drawdowns can directly affect your retirement timeline. So then people look at the other option. Let's get conservative. Let's start moving more to bonds, cash, and lower volatility investments. That can certainly reduce some of the volatility, but now it creates a different problem. You may still have decades of life ahead of you. Inflation is still working against you. Your spending is probably going to continue increasing. And if you get too conservative too early, you may give up a lot of the growth that you still need. So now you're stuck between two risks. Too much risk can derail the plan. Too little risk can starve the plan. And that leads to the question that really drives my entire investment philosophy. Is there a third option? Do we actually have to choose between staying aggressive all the time and becoming increasingly conservative simply because we got older? I don't think that you have to. So this brings me to one of the most important principles behind my approach. Protect first, grow second. And I want to be careful with what I mean by protect. I'm not saying that we can eliminate losses. We can't. Investing involves risk, and there are going to be periods where portfolios go down. What I care about is trying to avoid unnecessarily large losses, because losses and recoveries are not symmetrical. If you lose 10%, you need about 11% gain to get back to even. If you lose 20%, now you need 25%. 30% turns to 43%, and a 50% loss means you need 100% gain just to get back to where you started. Now that math matters at any age, but it becomes much more important when retirement is close, because recovery doesn't just require return. Recovery requires time, and time may be the one thing that you have less of. So when I say protect first, I'm not talking about eliminating volatility. I'm talking about recognizing that avoiding part of a major decline can potentially be extremely valuable when you no longer have unlimited time to wait for the recovery. At the same time, grow second doesn't mean stop growing. Growth still matters tremendously. We're just trying to solve for both. And this is where dynamic investing comes in. The basic idea is actually pretty simple. Risk doesn't have to be static. Most traditional portfolios start by asking, are you conservative, moderate, aggressive, moderately conservative? And then you pick an allocation and you maintain that regardless of what's happening in the market. I look at it differently. I think of risk more like a dial. There are environments where the evidence is favorable and I'm comfortable taking more risk. And there are other environments where risks are building and I'd rather be more defensive. There's obviously a large range between those two extremes, and the goal is not to predict every single move perfectly. It's not about saying the market's going to go down next Tuesday, so we need to get out. The question I'm asking is how much risk is justified by the evidence that we have today? And I think that's a much more useful question than deciding once that you're an aggressive investor and then maintaining that same level of risk forever. So, how do we actually decide when to turn that dial? I break the process into three broad areas. The first is macro analysis. I think of this as reading the seasons. You can think about four different seasons of spring, summer, fall, and winter as different macro or economic environments or seasons that have different conditions. And certain assets perform better or worse in those different seasons. And we can look at, what's happening with economic growth, what's happening with inflation, what are interest rates doing? And that creates different opportunities and different risks. And as an engineer, that makes a lot of sense to me. You wouldn't design a building with one loading condition and then assume that condition will exist forever. You evaluate the environment you're designing for. Investing should be similar. The second piece is market signals. I call this following the blueprint. What is the market itself telling us? What are the major trends? What is momentum doing? Is the market structure healthy or deteriorating? Because ultimately, I care about what prices are actually doing, not just what we think they should be doing. And the third area is risk controls. Once we have an opinion about the environment, how do we express it without making some huge binary bet? We use allocation ranges, position sizing, gradual shifts. So the process is ultimately understand the environment, listen to the market, and then adjust exposure accordingly. It's disciplined, but it's also flexible. Now, the obvious objection to all of this is you can't time the market. And I agree, you can't perfectly time the market. I can't tell you exactly where the top will be. I can't tell you exactly where the bottom will be. And I'm not trying to. This isn't about predictions, it's about probabilities. Imagine the evidence gradually stacking up in one direction. Maybe the economic backdrop is deteriorating, trends are breaking, momentum is weakening, risks are rising. None of those things individually guarantees a crash, but together they may tell me that being maximally aggressive no longer makes sense. Conversely, when conditions improve and the evidence starts stacking up positively, I'm comfortable adding risk back. I don't need to identify the exact top or bottom for that process to potentially add value. I just need to be willing to change my mind as the evidence evolves. And this is another important distinction. Dynamic does not mean reactive. I'm not sitting here watching CNBC, changing the entire portfolio because somebody said something scary. I'm also not flipping from 100% stocks to 100% cash and trying to guess when to jump back in. The changes are generally more gradual. If conditions are favorable, risk exposure might move higher. If conditions are mixed, maybe we sit somewhere in the middle. If risk is rising, we can become more defensive. But we're using defined ranges and gradual adjustments. That matters because the world is rarely black and white. I don't need absolute certainty to make a modest change. And if I'm wrong, I haven't necessarily made an enormous all or nothing bet. So the philosophy is dynamic, not reactive. Adjust when the evidence warrants it, but do it in a disciplined way. And this brings us back to what I think the actual goal of investing should be. It isn't to beat the S&P 500 every quarter or every month. It isn't to brag about having the best return at a cocktail party. The benchmark is your life, not an index. Can we grow your wealth? Can we manage market risk intelligently? Can we protect your timeline as retirement approaches? And can we keep your options open? Maybe that option is retiring at 58 instead of 63. Maybe it's cutting back to 3 days a week. Maybe it's selling your firm. Maybe it's traveling more. Maybe it's just simply knowing that you don't have to make major life decisions based on what the market happened to do this year. To me, that's what the portfolio is ultimately for. It's a tool to support the life that you want, not the other way around. So who is this really designed for? It's not for everybody. The people I'm specifically thinking about are architects and engineers, generally somewhere in their mid-40s through their 50s, maybe early 60s. You've built meaningful wealth. You've built maybe $1 million or more in investable assets, and retirement is starting to become real. Not something that's 30 years away, something you're actually starting to picture. And up until now, you've mostly just let your investments ride. And that might have worked for you, but now you're starting to think about what you've built and thinking, man, I really still want growth, but I don't want to lose 30 or 40% right before I'm ready to use this money. I don't want to push that retirement timeline back. If a major drawdown could materially change your plans, but you also don't want to move everything into conservative investments simply because of your age, then this is exactly the problem my dynamic investing approach is designed to address. If that sounds like you, I think the next step is pretty simple. You don't necessarily need to change anything today, but I do think it's worth asking one question. Does your current portfolio still match the life that you're trying to create? Maybe it does, maybe it doesn't. Maybe the amount of risk that you're taking today is completely appropriate. Or maybe you're still investing like the 35-year-old version of yourself, even though your goals, timeline, and financial situation have materially changed. If you have $1 million or more invested and retirement is starting to feel real, scan the QR code below and schedule a conversation with me. We'll talk about where you are today, where you're trying to go, how your portfolio is currently positioned, and whether a more dynamic approach makes sense for you. There's no need to guess. Let's just take a look at your investment strategy and see if it still fits the life that you're trying to create.